Have you ever felt like you're doing everything right with your money and it still doesn't feel like enough? You've got a job. You've got a 401k you barely look at. Maybe you've even got some cash sitting in a savings account for later. But nobody ever hands you the actual formula, the one that turns a normal American paycheck into a life where money stops being the thing you worry about. Here's a question that changes that. What if you took $150,000 from savings, a home sale, an old 401k rollover, whatever got you there, and split it across just 5 Vanguard index funds? Build it one way, prioritizing dividend income, and that $150,000 immediately starts paying you close to $4,500 a year in completely passive income without you lifting a finger. But build it the other way, same 5 funds, same starting number, but structured for pure long-term growth. If you let it compound over the next 30 years, based on historical stock market averages, that exact same $150,000 could grow into over $2.5 million by the time you retire. Same money, same funds, 2 completely different futures. Most people don't realize they have a choice. Let's build both. Before we touch a single fund, let's talk about why this decision even matters right now. If you're like most Americans, you've probably faced this exact fork in the road without realizing it was a fork at all. You get some money through work, an inheritance, selling a house, a divorce settlement, and you're told to just invest it. So you open a brokerage account, you see a search bar with thousands of tickers in it, and you freeze. Nobody explains that picking the perfect fund matters far less than your overall strategy. Specifically, how much of your money goes into stocks versus bonds. This is the exact moment many people get stuck, and here's why. The finance industry loves to make this complicated. Actively managed mutual funds often charge you 1% a year, yet according to S&P's own data, nearly 90% of them underperform a plain market index over a 15-year stretch. Financial influencers push single stocks like they're lottery tickets. And meanwhile, the boring, unglamorous truth just sits there ignored. A handful of low-cost index funds, weighted intentionally, can do almost everything a fully diversified portfolio needs to do. So let's define our terms quickly, because we're going to use them a lot. An index fund is a basket of stocks or bonds built to track a specific market benchmark. Nobody inside Vanguard is handpicking winners. The fund simply owns whatever companies sit inside that index, in roughly the same proportion. That's why these funds are incredibly cheap to hold. Some cost as little as $3 a year for every $10,000 invested, and why they've historically beaten the majority of expensive, actively managed funds over long stretches of time. A dividend is simply a portion of a company's profit that gets paid directly to shareholders, typically 4 times a year. Own more shares, collect a bigger payment. Some companies pay generous dividends. Some pay almost nothing and instead reinvest everything into growing bigger. That distinction is going to define exactly how our 2 portfolios behave. Now here's why this matters right now. In 2026, more than it did a decade ago, interest rates have moved. Inflation has reshaped what enough actually means for retirement. And an entire generation of investors, many of you watching this, are sitting on either a lump sum you don't know how to deploy or a monthly contribution habit with no real destination in mind. The question isn't, should I invest? You already know the answer to that. The question is, what am I actually building? And does it match what I want my life to look like in 20 or 30 years? That's the gap this video closes. Not which fund is best. That question, on its own, barely matters. The real question is allocation. How much of your money goes into the pieces built for growth versus the pieces built to pay you? To do that, we need 5 funds that each do a specific job. Think of it like assembling a team, not just grabbing whoever has the flashiest stats. Job 1, something to anchor the whole portfolio in stable, established American companies. Job 2, something built to chase aggressive growth, even if it comes with more turbulence. Job 3, something reaching into smaller companies that haven't had their breakout moment yet. Job 4, something built primarily to generate consistent income, not just share price growth. Job 5, something exposed to economies outside the US that are still expanding, for both diversification and long-term upside. 5 jobs, 5 funds, all from Vanguard. And because Vanguard is uniquely structured to operate at cost, all of these funds have expense ratios under 0.1%, meaning you keep essentially all of your returns instead of handing a chunk to a Wall Street manager. Here's the exact lineup our investor, we'll call her Maria, ends up choosing after comparing dozens of alternatives. If you're already nodding along because you've got a pile of cash sitting in a money market account, which might yield around 5% right now, but won't build generational wealth or outpace inflation long-term, stick around. Make sure you're subscribed to Orin Invest, because the next section is where this stops being theoretical and we look at the exact tickers. Now, Before we look at Maria's 5 funds and what they're actually projected to do, let's talk about the 2 mistakes that quietly wreck most people's version of this plan. Mistake 1. Chasing yield without checking why the yield is high. This is where a lot of new investors fail constantly. They see a fund advertising an 8% or 9% dividend yield and think they've found a shortcut to early retirement. But almost every time, that yield is high because the fund's share price has been plummeting or because the fund is paying out its own capital instead of real earnings just to keep that percentage looking attractive. According to Vanguard and Schwab data, a sustainable yield for a standard U.S. stock index fund typically sits between 1% and 4%, depending on whether it's tracking the broad market or focusing strictly on dividends. Anything dramatically above that deserves a hard second look before you commit real money. Mistake 2. Treating diversification as I own 5 funds instead of these 5 funds barely overlap. Here's the trap. You could technically own 5 different funds and still have up to half your money riding on the exact same handful of mega-cap tech companies. Why? Because so many different popular ETFs all secretly hold Nvidia, Apple, and Microsoft as their top 3 positions. Real diversification means looking under the hood. You can use free tools like Morningstar or the ETF Research Center to check what's actually inside each fund, not just how many tickers you're holding. This is where most portfolios quietly become fragile, not because people pick bad funds, but because they never check the overlap. If you want me to do a video showing you exactly how to screen for overlap step by step, let me know in the comments below. Now, here's the actionable part. Maria ran every major equity index fund through a simple filter: rock bottom expense ratios, historical performance, and exactly how much their top holdings overlapped. 5 Vanguard funds survived that filter cleanly, each one earning its spot by doing a job none of the others could fully replace. Fund number 1, VOO, the Vanguard S&P 500 ETF. The anchor, roughly 500 of the largest U.S. companies, market cap weighted. With a 0.03% expense ratio, it's practically free to own. VUG, the Vanguard Growth ETF. The engine, a more concentrated bet on U.S. companies expected to grow earnings faster than the broader market. Think large-cap tech and consumer names with aggressive expansion stories. VB, the Vanguard Small-Cap ETF. The wild card, roughly 1,400 smaller U.S. companies that haven't reached large-cap status yet. They carry more risk, but this is the pool tomorrow's giants get pulled from. VEA, the Vanguard FTSE Developed Markets ETF. The stabilizer. These are established economies outside the US, Japan, the UK, Germany, Canada, Switzerland. These are mature companies that often have a much stronger, more reliable dividend culture than their American counterparts. VWO, the Vanguard FTSE Emerging Markets ETF. The long shot. Economies still rapidly expanding. Taiwan, India, Brazil, China. You get higher volatility here, but it captures the raw economic growth of developing nations and historically offers a higher starting dividend yield than the U.S. market. 5 jobs, 5 funds. But, and this is the part almost everyone gets backwards, picking these 5 tickers was the easy 20% of the work. The other 80% is what we're about to build right now. 2 completely different portfolios out of the exact same 5 ingredients. What happens if you take $150,000 and build a portfolio designed to do exactly one thing? Pay you for the rest of your life, without ever selling a single share. This is the part where that $150,000 splits into 2 entirely different lives. Let's build the income-tilted version first, the version designed to pay Maria. Now, quick reminder before we dive into the exact tickers. I'm not your financial advisor, and investing always carries risk. This is strictly for education. Picture this for a second. It's a random Tuesday, 15 years from now, and money just shows up in Maria's account. Not because she sold anything. Not because she logged in and did something clever. It's just there, the way a paycheck used to be. Except nobody's making her show up to earn it anymore. That's the feeling we're building toward. Portfolio 1, the income build. 35% into VA, $52,500. The biggest slice, because developed international funds tend to carry the highest sustainable dividend yields of the group, often sitting right around 3% according to Vanguard's current SEC yield data. 20% into VWO, $30,000. Giving us exposure to emerging markets, which historically pay higher dividend yields, adding a nice cash flow boost to the overall pie. 20% into VOO, $30,000. The anchor stays substantial, keeping the whole build grounded in blue-chip American stability. 15% into VUG, $22,500. Even an income-first portfolio needs a real growth engine. or the account eventually stalls. 10% into VB, $15,000. The smallest slice, because when you're building a reliable stream of passive income, the highest volatility piece should never be the biggest one. Blend those five together based on current Vanguard data, and this portfolio runs at roughly a 2.1% starting yield, aiming for a historically conservative total return of about 8.5% a year. Here's what that's projected to become. By year 10, around $339,000. By year 20, $766,000. And by year 30, assuming those dividends are reinvested along the way, this portfolio could reach approximately $1.73 million. At that point, if the yield stays at 2.1%, it generates about $36,000 a year in passive dividend income. That's $3,000 every single month. Not from selling shares, not from timing the market, just from owning the pie and collecting the slices as they're paid out every quarter. And if she holds this in a U.S. Roth IRA, every penny of that income is totally tax-free. Now here's the twist. Because Maria isn't just one person, she's also the version of herself that doesn't want dividend checks right now. She wants the biggest possible number waiting for her at the finish line. Same 5 funds, opposite weighting. Hit subscribe so you don't miss part 2, where we break down exactly how much larger the growth portfolio gets. Now let's look at the exact opposite approach. Portfolio 2, the growth build. 50% into VUG, $75,000. Half the entire account now rides on the most aggressive growth engine in the lineup. 25% into VOO, $37,500. Still the anchor, just scaled up to add more steady large cap exposure underneath the growth bet. 12% into VB, $18,000. The small cap long shot gets a bigger seat than before because this build can absorb more volatility. 8% into VWO, $12,000. Emerging markets stay in for diversification, size down from the income build. 5% into VEA, $7,500. Developed international nearly disappears. At this weight, it's insurance, not an income source. Averaged together, this build runs at roughly a 1.1% starting yield. But here, we aren't chasing yields. We are chasing total return. Assuming a historically aggressive but realistic total return of about 10% annually, similar to the historical average of the S&P 500. Here is the math. Projected out, by year 10, you're looking at around $389,000. By year 20, roughly $1 million. And by year 30, this growth-tilted portfolio is projected to reach approximately $2.62 million, far outpacing the $1.73 million income build from the same $150,000 starting point. But there's a trade-off. Because it yields just 1.1%, the passive dividend income on this massive account by year 30 comes to only around $28,800 a year. So here's the uncomfortable moment Maria has to sit with. The account that grew nearly $1 million larger actually pays her less passive cash than the smaller account. That feels like a contradiction until you remember the 4% rule, the standard U.S. retirement guideline backed by the famous Trinity study. It says you can withdraw roughly 4% of a portfolio annually in retirement without running out of money. Apply that to the $2.62 million growth build, and you get roughly $104,800 a year, nearly triple what the income build pays passively. That number is real, and for a lot of people, it's the better answer. But it comes with a catch the dividend build doesn't have: selling. That $104,800 a year only exists if Maria logs in and sells off pieces of the account every single year to generate it. And depending on what kind of account she holds this in, selling triggers capital gains taxes. Furthermore, if the market crashes the same year she retires, she's forced to sell her shares at a loss just to pay her bills. A real, well-documented danger in financial planning called sequence of returns risk. The income build never asks her to sell a single share. Assuming companies don't slash their payouts in a recession, those dividend checks show up regardless of whether the stock market is red or green that quarter. Neither portfolio is wrong. One hands you a much bigger number that you have to slowly take apart. The other hands you a smaller, steady paycheck while the whole account keeps standing, untouched, growing in the background. That's not a math problem. It's a values problem. and only you can answer it for your own life. So I want to know, if you had $150,000 right now, are you choosing the growth build or the income build? Let me know in the comments below, and hit subscribe for more portfolio breakdowns. Let's bring this all the way back down to ground level. Because a spreadsheet full of 30-year projections doesn't mean much if you don't know what to do with it Monday morning. Here's what we actually covered today. 5 Vanguard Index Funds, VOO, VUG, VB, VA, and VWO. Each one doing a distinct job inside a portfolio. An anchor, a growth engine, a small cap wild card, an international diversifier, and an emerging markets long shot. The exact same 5 funds, split 2 different ways, produce 2 entirely different financial lives from the same $150,000 over a 30-year timeline. Based on historical market averages, one version paid Maria roughly $4,500 a month for life without her ever having to sell a single share. The other portfolio grew to over $2.5 million and could support a much larger withdrawal, but only by drawing the principal down over time. If you take nothing else from this video, take this. Your fund selection is not where your edge comes from. Nearly every serious American investor eventually ends up choosing from a similar short list of low-cost, well-established index funds. The real decision, the one that actually determines your financial outcome, is the weighting. How much money goes where? That's the lever you control, and it's the one almost nobody talks about. So here's what to actually do today, in order. Step 1. Open your brokerage account, Vanguard, Fidelity, Schwab, it doesn't matter which, and pull up your current holdings. Check your actual overlap using a free tool like Morningstar's Portfolio X-Ray. You might already own 3 funds that are secretly betting on the exact same 20 tech companies without realizing it. Step 2. Decide, honestly, which version of yourself you're building for. Are you someone who wants a paycheck that never requires you to sell? Or someone who wants the largest possible number and is comfortable drawing it down carefully in retirement? There's no wrong answer here, but building without deciding first is how people end up with a portfolio that doesn't match their actual goals. Step 3. If you're starting from a lump sum like Maria did, resist the urge to time the market perfectly before investing it. According to Vanguard's own research, historically, investing a lump sum immediately outperforms spreading it out roughly 68% of the time, simply because more of your money spends more time growing. Step 4. Revisit your weighting once a year, not once a week. These 5 jobs don't need daily attention. They need patience and a calendar reminder. I know $150,000 sounds like a mountain if you're starting from zero or from a few $1,000s in a savings account. That's fair, but the framework doesn't change with the size of the check. The same 5 jobs, the same weighting logic, apply whether you're starting with $1,500 or $150,000, especially now that most major brokerages let you buy fractional shares of ETFs. The compounding math simply needs more time to work with a smaller number, which is exactly why starting the decision-making process today, not the perfect allocation, just the decision to build intentionally, matters more than waiting until you have enough. Now, quick reminder, I am just a guy on the internet, and this is for educational purposes, not personalized financial advice. But if this breakdown actually helped you see your own investing decisions more clearly, that's genuinely the whole point of this channel. Subscribe if you want more breakdowns like this one. Real fun mechanics, real trade-offs, no hype. And drop a comment telling me which version you'd build, the paycheck or the mountain. I read every single one, and it usually turns into the best conversation in the comments section. You've got the funds. You've got the framework. Now it's time to decide what you're actually building, and go build it.